Representative Porter, are you here? If not, we'll wait. I'll do my,
I am here, sir, but Mr. Lowenthal, you can go first if you'd like.
no, I'm gonna wait. Representative Porter.
Thank you. I have questions for Mr. Shork. What percentage of oil and gas leases on the outer continental shelf, which we commonly refer to as offshore leasing, are not producing oil and gas?
Well, the numbers I provided for today's hearing were really related to overall, and it was basically 2/3 of them, the wells, looking at the wells. So
okay, so about 2/3 of the wells are not producing oil. They're not contributing to energy availability. They're not changing consumer prices. They're not creating energy independence. They're not producing. They're just sitting there. Now, when an oil company stops drilling offshore, do they immediately take away the platforms, the rigs, the wellheads, the artificial islands, the power cables, the pipelines, so that nobody can tell that the oil company was ever there?
No, they do not.
So I have a question. Does the lease require, these are federal leases, this is our public land, do the leases require offshore oil and gas companies to, when they're done drilling, to remove all equipment and permanently plug these wells?
So what the leases require, so when they cease production, they have basically 1 year
Shane?
to do that.
Okay, so when they cease production, they're supposed to decommit. We call that decommissioning, where they're supposed to remove the equipment and permanently plug the wells. The GAO has said there are about 38.2 billion in estimated decommissioning costs for the Gulf of Mexico alone. Do those companies have enough bonds and dedicated financial instruments set aside so that regardless of the up and down of whatever their company's making, we can be sure that they'll be able to pay those decommissioning costs and taxpayers won't be on the hook?
No, what our review of Bessie data shows is that they currently provide something less than 1/10, and it could be of the total amount expected cost.
Okay, so I think what you said is it's about 2.9. I like numbers. It's about 2.9 billion. Let's just give them the benefit of the doubt. Let's round up to 3 billion. But there's about 38 billion of potential costs. So companies we're counting on these oil and gas companies to have the profits, the cash, to make the investment, to clean up when they're done. Have they been doing that?
Well, typically what we will see, the answer is not really. Typically what we'll see is well-to-do companies will transfer these assets into other entities that have less financial means and wherewithal to actually conduct the cleanup.
So they're moving, once they've taken the money and they've made the profit, then they're basically transferring away the unprofitable, difficult, expensive part of this, which is the decommissioning portion. And they're transferring that, are they transferring that to big, healthy companies?
No, often they're transferring it to companies that didn't exist even just prior to the transfer. So
you mean a shell company?
Yes.
Like an entity created just for the purpose of pushing off the cost of doing business so that you don't have to pay it even though you got all the upside? Are you saying that this is what oil and gas companies do?
We've seen this, yes.
And how does the law facilitate this?
Well, how does it facilitate it? Well, I suppose on a couple of levels. On the one hand, there's very little oversight of the transfer. And so there's very little restriction from a regulatory standpoint. This is true offshore and also onshore. So we see this behavior in both places. And then secondary to that, there is actions that companies can take in bankruptcy that can effectively pass these liabilities on to taxpayers eventually. And so some of it is to be able to use that in the event the new company goes bankrupt.
So I was a bankruptcy law professor before I came to Congress, and I taught business law. And a lot of these laws about allowing companies to create sub-entities, to sell assets, to file bankruptcy when they're in financial trouble, they exist for really good reasons, but they also can be abused. And the result of that is we, the taxpayers, having given oil and gas companies our oceans, our public lands, our wildlife, our nature, our planet, to make profit end up on the hook if they take advantage of this legal scheme and these transfers, and then they put us on the hook for that. Why shouldn't we have higher bonds and make sure that no taxpayer is on the hook for cleaning up a mess that another company profited from making?
No, certainly no private actor would do what the federal government does, which is not have a security for these risks.
So taxpayers are being asked to take on risks that private companies wouldn't. We're giving the oil and gas companies a bargain deal here in terms of offshore liability, because we're not asking them to indemnify, to protect us, to have bonds, to make sure we're saying, take our public land, take our water, in this case, drill, and if at the end you want to hand back the mess to us, that's okay. That's currently what the government's doing.
That's effectively what is happening, yes.
Well, that is not acceptable to me. I don't think it should be acceptable to anyone on this committee, regardless of party. If there's going to be offshore drilling, and there currently is, then, one of my favorite phrases is, you buy the ticket, you take the ride. You buy the ticket, you lease, you take on the oil and gas company lease, then you take the ride, and that includes paying for the full cost of decommissioning. And that's exactly what I think the federal government ought to be requiring of oil and gas companies, is protecting taxpayers when they want to benefit from the taxpayers' property. Thank you very much, Mr. Chair. I yield back.